I'm pretty sure everybody probably knows the three of you. If you're here, you're aware of the VC scene. VCs are the enemy of this cycle, and so I want to first dig into one of the things that we've heard a lot of criticism of VCs over the last call it 3 to 6 months, which is the overfunding of infrastructure versus applications. Okay. This is kind of it's a refrain that everybody seems to keep repeating. It's the common mantra. Infrastructure is overfunded. Do you guys agree? Yes or no? Why? Kyle, why don't you start?
Yes, generally. We have fast L1s. We have on and off ramps. We have key management systems. Basics work, bridges, all that shit. So we're not really investing in that stuff anymore. We haven't in quite some time.
Okay. What do you think explains the delta in valuation between all the infrastructure companies and the applications which tend to be valued less?
I mean, I think that's harder to do. I mean, look, if you
the market's wrong.
If you assign a 1 or 2 or 3% probability to like a thing being worth 15 billion in 2 years, then you can underwrite kind of any investing decision.
Yeah, I mean, one way to look at it is it's downstream of these grandiose narratives. In infrastructure, like an app, you can sort of like put a future TAM on, and you can put like, oh, this is how much money it's going to make. And infrastructure is like, oh, it's going to be like this generalized computing platform, and Amazon is worth $2 trillion, and so this is like AWS, which makes all the money. And so you can like back into these ridiculous narratives that make it easy to justify really large valuations. And so it's a little bit of a side effect of, I think, a lot of easily influenced people in the broader market who think of these like big narratives, and then you can kind of back into.
So do you agree that infrastructure is overfunded relative to applications, or no?
Yes.
You do think so?
Yeah, yeah.
Why do you think why do you think applications are not getting more of a bid, if that's true?
You mean on the market, like retail side, or do you mean from the VC side?
Both.
I think from the market side, it's because it's easier to put a number on it. You can look at a cash flow and you can say like, oh, here's how many users there will be, here's how much money they'll pay you, here's how much payment volume there will be. Therefore, you can make this much, and then it becomes. I mean, if you just look in the world, there's not that many $5 billion companies in the world, right? And so it's harder to sort of make the math work when it comes to exit, and therefore people are more rational on the front end. But the other reason I think is it's harder to build, and there's just fewer of those people. Like the type of person that understands enough to like build something on a wallet as a service, or build something on top of Solana. Like you need enough technical depth, but then you also have to be good at UX and acquiring users, and it's just harder. So there's just not as many founders who are good, which means there's upstream not as much money going to go into it.
I actually have a theory, and sorry to cut you off, Hans.
No.
We were very early in helium, and helium has been a very interesting example for us, because to us, we thought at least like the vision was very cool, like trying to disrupt telecom, and like it's super hard and they have a long way to go, but like at least the idea is very sexy, and like telecom is like one of the largest markets in the world. And one thing we've observed over the years is we've like told other people about helium, both professional investors and retail audiences, is like the learning curve to learn about telecom is like, okay, like I have to go commit a minimum X number of hours to like learn about that before I'm going to buy this token. And our observation is that like most people are unwilling to do that because it requires like a very different knowledge set than the like DeFi NFT knowledge set.
So you think it's just a lack of knowledge from crypto investors that means that these things are priced at a lower premium?
I think that I'm fairly certain that's true for helium, and I suspect that is probably true for any application that requires at least some market-specific knowledge.
And do you think that changes, or is that just like, okay, we're sort of fucked if you're investing in something that's too far from the core of crypto?
Markets will mature.
Markets will mature.
Well, that's alpha, right? I mean, if you're willing to go deep on something, like we've done this in a couple of domains too, where it takes a while to get up to, like reinsurance, or investors in a reinsurance company. It takes a long time to get your head around the insurance markets and reinsurance markets, and then how blockchain or smart contracts or DeFi protocol might work there. But if you put in the work, then you realize that there's just like nobody else around. There's no competition. Like nobody knows how to do it. There's not that many founders, and so instead of being like the 30th, DeFi protocol that does the same thing, like some tweak on perps, here you are on like a $1 trillion market where there's no competition. And so I think the smart VCs, whether it's telcos, infrastructure, healthcare, massive like TradFi markets, there's like trillions of dollars sitting there, and so smart VCs will go after it.
Vance, what's your take?
We're bullish on infra still. I think there's work to be done in terms of maybe not the speed and cost of blockchains, but frankly the alignment of blockchains. Like Helium is a good example. They just launched an L2 on Solana. I expect there will be more of those in the pipe. Like, how do you actually get people rowing in the same direction? There's a ton of fees in just DeFi and block space, and the traditional kind of crypto native revenue drivers, but you kind of have this fragmentation problem that always persists. Like, is Uniswap aligned with ETH? Is Maker aligned with ETH? Can you enshrine those things? Can you get the L2s to pay consistent rent? I think that's kind of more where the innovations in infrastructure will come from going forward versus like more block space, cheaper block space. I think we've kind of been there, done that, and I would expect to see some of those valuations compress. The other side of that is that Polkadot's still at 10 billion. So like, you know, you kind of, you get what the incentives are at some level.
Okay. So do you think then that we have a dearth of applications in this space, or you're like, well, kind of, but really infrastructure is the biggest problem?
I mean, I think, like, not to, you know, shill Barachain, but like, if you have all those primitives aligned, if you have block space and, you know, all the fee base of that blockchain being all the apps that are enshrined, the proof of liquidity keeps everything aligned, like, you can probably get to like 3 or 4 or 500 million of revenue, and then, you know, you slap a multiple on that, and that's the most impressive chain. And I think to some extent Hyperliquid has this as well. So I don't think there's like, you know, an existential problem with infrastructure versus apps. I think in many cases they're all the same thing in crypto. Like you said, you know, Dogecoin is consumer, Pump Fund is consumer. It's going to look a little bit different, but it's inherently tied to the infrastructure. And maybe, like, you know, what does Pump.Fund do in the future? Do they move off Solana? Do they have the alignment? Can they, you know, continue to be the bull case for Sol? I think that's going to be kind of the existential question of this cycle, is like, can you keep everyone kind of moving in the same direction? I don't think without enshrining it into the infrastructure level, you can actually do that.
One thing I'll add here, I think, is like, at the end of the day, I mean, there's sort of like, if you've been in space long enough, it's also just, it kind of gets boring to look at the same stuff over and over again. And you're like, what am I doing? Like, do I really want to look at the 18th version of the same thing again? And so it's just more interesting if somebody comes along and is like, hey, here's an application of this thing that you wouldn't have thought of. Here's how we could apply this to, I don't know, AI. Here's how we could apply this to some market, you know, telco that you just wouldn't even thought of. And just from like a what do you want to do with your life perspective, it's just way more interesting. So I don't know. I would encourage a lot of founders to sort of think about, well, what the hell do you want to do with your life, and do you want to be like the 90th person to do the same thing, or do you want to go like do something novel and interesting? And frankly, I think for this stuff to really go mainstream, we were talking about like GPT earlier, right? It's like you kind of need a Chat GPT kind of, you know, end user application, and then that ignites this interest in the space that's like, oh, now I get it. Because right now I think everybody here kind of gets it, but there's a lot of people in the world that look at this as infrastructure and they're like, I don't see it quite yet. So it's hard to deal with these abstract things like financial infrastructure even. And so we could get a couple of like really, really killer apps built on top of this stuff. I think it would also ignite like a whole new cycle of investment and interest. And
Okay, so speaking of this cycle, one of the critiques that many people have levied against VCs is the rise of these high FTV, low float launches, which are often called, also tied together with the concept of VC coins. And many people feel like VCs have been uniquely extractive to crypto over the last few years. And there was a tweet by, I think, Archer Chong from Defiance, where he said that crypto really needs more hedge funds and less VC funds. Because the VC funds, you know, they back these projects very early, they put in a little bit of money, and then the project goes live at a multi-billion-dollar valuation, and then they sell their tokens, you know, selling them to retail, and so really they're taking money out of the economy rather than putting money in, right? That's the argument. And the liquid funds, at least, they buy the tokens that all the VCs are creating and launching in these markets. What do you think of that idea? Is that a good description of the market structure in crypto? Is something broken about it? And if so, how should it get fixed?
I think it's a generally accurate description. The reason it happens is because it's easier to raise a VC fund in crypto than it is in traditional world, because the times of the liquidity is shorter. Raising money from LPs saying, hey, I'll invest now, I'll sell the company in 11 years, is like, very few people want to sign up for that, and very few LPs believe that anyone who tells that to them is capable of doing that productively. So that's why it happens. I think actually the solution is actually to move in the opposite direction. I've been a very public advocate of 100% unlock on day one for all tokens. This has not happened and will not happen under the current regulatory regime in the United States, because there's a rule called Rule 144. I won't get into all the details of it, whatever. But that's why all of these things launch with small floats. They used to be 1%, 2%, 3%. Now they're more like 10-ish%. We push our portfolio companies to go higher than that if they can. But I think what happens is if you are in a world in which the norm is everyone launches with a 100% unlock, then if the token is trading at $4 billion on day one, like the price is going to collapse very quickly to what it should be, whether the price is 100 million or 200 million, whatever. And like, yes, some VC will have made some extractive profits, and you'll have a vertical line on the can, like fine. But then at least now the market price from that point going forward will be correct. And I think the worst thing is all of these teams launch tokens, and they have 2, 3, 4 years of hangover of everyone else is like, I don't want to buy that thing. Like, the VCs are up 30x. Like, I'm gonna, lockups explicitly distort the price. Like that explicitly is what they do. There's no way around that. And I think the solution is like get rid of the lockups. Things will open at lower prices. It may take some time. It may take a week. It may take 6 months. I don't know. But I think the market will adjust and realize, hey, it's very dumb to open at a $4 billion price.
So you think this solves the problem? The market structure problem is solved if everything instantly unlocks?
I think that is easy, like conceptually, and solves probably 90% of the problem.
90%. Okay.
Yeah.
Do you guys agree with the story?
I don't know if VC coins are that much more extractive than the historical capital formation process of crypto. I think ICOs were frankly way more extractive, and there was no semblance of we're giving 50% of this to the community or there's an airdrop. It was just like pure retail, bacchanal, gas wars to hit the contract, and that was kind of it. I don't know if unlocking everything on day one solves anything. I think that may even hurt a lot of projects that are giving out ongoing incentives. Like I think about, like helium, not that helium was like low float FDV, but like the more those emissions are worth, which is a function of the float, the more you can incentivize, the more you can bootstrap, the more you can kind of do that. But I think at the end of the day, like Solana was a VC coin, Joe Lubin funded ETH, these have all been huge retail wealth generation events, and even the ICO bubble, in the fullness of time, that was probably 10 billion in and a few hundred billion of FDV out. So it's just about selection. And at the end of the day, you do have to do your own research. Well, I don't think we're going to solve anything by, different enforced market structure. That the social consensus of that it would be impossible.
Well, I think there's three other things going on here. So one, there's a lot of people calling themselves VCs that are not actually VCs. Like my definition of a VC is somebody who comes in and is actually going to roll up their sleeves and help you and be committed with you for 5, 10 years. And when things go south, they back the truck up and they double down, right? And actually the reality is most people are not VCs. They call themselves VCs, and that sort of taints the name. Now, that's one. Two, I think there is an incentive structure because you're giving out tokens as incentives to build your ecosystem to drive up the value of the token, especially on the private side, and that lets you give away fewer tokens. And so I think it's incumbent upon founders to be much more disciplined about this. And so part of it is like, okay, well, yeah, you could go raise it 2 or 3 or 4. Should you? In some cases, you should, actually. That makes a lot of sense. And in some cases, if you do, you're going to Kyle's point, you're going to kill the project. And so I think there's actually a discipline required from founders in terms of how to manage the float and how much to put out there and what valuation to raise at and be really, really smart about that. 3, I think that actually, I'll take the other side of Kyle's take here, which is I think that forced holding is actually really good for most people. And actually I'll take the other side, I think more people should be subject to longer lockups. And you see this, for example, with, I can't remember if it's like Schwab or Fidelity, but somebody's done this research where it's like, the people who forget their passwords are the ones that perform the best on the equities markets. Right? It's like, yeah, because it's hard, and these things are really volatile, and most of them are going to go up and down a lot, even the winners. But if you think of these things as a venture portfolio, which is like if you're in the ETH ICO, you crushed it, and kind of nothing else mattered. What you really want to do is force people to hold. And I'm not even talking retail. Like set that aside for a second. It's like you want your team to hold. You want your employees to hold. You want the investors to be forced to hold. And I think that there's a reason that the technology markets for the last 30 years have snapped to that. Because I think that forced hold actually creates alignment. Because actually most people don't have the discipline to go through that, and it can actually wreck a culture. Like when a stock price goes down 80% of the company, like a lot of people will leave, your competitors will poach people, yada yada. So I think there's actually like structural reasons that these longer lockups were invented in the first place. And actually, like the sort of mixing of unlocked versus fully locked people is actually what creates a lot of the mess here. Like
I want to get your response to that. I want to get your response to the challenge they pose.
Like here, I'll throw out the question, right? It's sort of like the VE models on Curve are kind of interesting, right? Like if you could create alignment where it's like everybody that's buying the token is locked up for 4 to 6 years, including the team, including the investors, including anybody that wants to buy in, and they're buying in on preferential terms. That's, I think, very interesting, and that is analogous to what happens on the equities markets, Until you're like truly sustainable and at scale, everybody that's buying all the way up is locked up for many years. And in those cases, you don't even have line of sight. It's not like, oh, lock up for 3 years and we'll IPO. It's like, please lock up, and maybe one day at some point in the future we'll IPO.
What's your take?
It's basically the exact extreme position from yours, which is like even retail should be locked up for 6 years.
Yeah, look, I mean, you can't have a liquid market if everyone is locked up. Like, by definition, then it's no longer liquid. Like, it would be nice if people are forced, like, if employees are forced holders, like, sure, but I don't know. I kind of look at it as, like, it's the job of the CEO. I mean, if you forget about early stage companies, you look at a mature public company, all the employees get stock options when they work there. Those stock options vest over 6 to 12 months, and then they can sell their stock whenever they want to, right? They work there as an employee. And, like, the CEO's job and leadership team's job is to convince not only the public at large to, like, buy the stock, but also to convince the employees to not sell their shares. And, like, that's part of the natural process of the system.
Sure.
And, like, I think the same thing applies in the early stages. Now, the difference between traditional markets and crypto is investor disclosure on which employees are selling. And, like, if you work at a publicly traded company, you want to sell your shares, there's some process you have to go through, right, to do that.
Yeah.
So I do think you need investor protection around it. But I think, like, you act, like, you know, if you had great public dashboards on Dune and Nansen and Masari and whatever that show percentage of insiders that have sold over the last X months, like, those are very easy dashboards, you know, to construct if the basic disclosure requirements are there. So I think you can get to the outcome of filter out all the quiet quitters, and, like, great, the token price goes down because they left, and now the token price is more attractive, so now you can go attract better talent at a lower price. Like, everything here has a natural equilibrium to it. And, like, the best people will navigate that, and the worst won't. And, like, great, like, let the free market allocate accordingly.
Would you, how would you feel if there was a founder in your portfolio that had sold, you knew they sold all their tokens?
I mean, great.
You think that's great? Okay, let me ask you,
No.
what if there was somebody at Multicoin who worked for you who sold all their carry? They, like, sold all of it to another party at the moment they joined the firm. Would that change your perception of?
I mean, it's a perfect example. Do you let your employees freely trade their carry in the fund?
No, we have, like, obviously a compliance process, and, like, we have restricted assets and unrestricted assets.
Sure. But they sell, they sell a forward on their carry or something.
Yeah,
else.
like they, you know, if they disclosed it and they're going to.
Yeah, selling forward on carry, I'd find to be a problem. And I think selling forwards on is wonky. And look, I think a lot of this is like holding the position. My position is that you should have maximum freedom, but then, like, there are norms, and, like, and the people who violate those norms hopefully will be punished, meaning, like, the price of their respective tokens will go down commensurately.
Yeah.
And, like, you need to have the regulations in place around disclosure so that, like, people will act accordingly. The problem right now is if you have free markets without disclosure, like, that's clearly a bad.
Yeah, I agree with that.
A bad.
Sure.
concept.
Yeah, we're in a weird, like, local minimum where we have, like, the worst of both worlds right now.
Correct.
Okay.
Yeah.
Okay, so Kyle, you're an unlock maxi.
Yes.
You're an unlock mini, or a locked up maxi.
Unlock maxi.
What's your take on, do you think token unlocks work? Do you think they're broken? Should they be changed?
I mean, the one example of unlocking all the tokens is Friendtech. And I think that's trading at like 15 million FTV. And so, like, I think on some level, it's just not viable to do that. I think the great thing about this industry and permissionless tech in general is, like, the solution to having, you know, less coins is actually having people launch more coins in the near term. Like, let's figure out what works. Let's figure out what doesn't. It seems like the exchanges are now kind of the police of some, you know, sort. Although they did list a meme coin yesterday, but I think we're going to figure it out if we launch enough coins. Just because the incentives are no longer going to be there for funding things that are redundant, funding the 18th perp deck on the 5th chain. I think what the market is really yearning for is novel use cases, and I don't think it needs to be like, you know, Instagram on chain. I think energy is interesting. I think, you know, Kyle just led a round in a company that does DePIN with energy. I think that's a super interesting category. And I think it's possible to build amazing things on crypto. It's just like we need more than like a few years' time to get there. So I'm pretty optimistic. I don't know how much it has to do with the actual structure of the tokens. Like, I don't know what Solana's like allocation of the pie chart and when it unlocked, but, like, it went through some brutal times and then it got really, really good. And, like, the cognitive dissonance of people saying, like, you know, a 3 billion coin is like, you know, it's if there's only 10% float, it's too extractive, but at the same time, you know, Bitcoin's at $1 trillion, ETH's at 250 billion, Solana's at 80 billion. Like, there's something there which doesn't quite make sense. You can't really have it both ways.
I will say too. I think one of the things that's a little different here so back to your market question is, I do think that the token markets are going to have much higher network values than traditional companies do market caps. And effectively the reason is that what you have are market participants in a lot of the world that don't have access to the dollar. And so if you're in like a 10 or 20% interest rate regime, all of a sudden getting a bunch of dollars is great. And B, they don't have access to productive financial products that can give them dollar cash flows of any sort. And what you have with a lot of these tokens is sort of a potential dollar cash flow, fee-taking sort of asset, plus some sort of call option, like on a venture return. And that's like the best possible asset that could possibly exist. If you're in Nigeria, if you're in Brazil, if you're in parts of Southeast Asia, Indonesia, like Eastern Europe, like that is better than any financial product you could possibly create. And so in effect, the way the market will manifest that will be through very, very high PE. So I think there's also this element that people have a difficulty reconciling, which is like, why can such and such thing be worth $1 billion? As a company, it would only be worth 100 million or whatever. But I actually think that's pretty rational. And so there's also an element of, I think, I don't think the network values will ever converge to like market caps of companies, and that's always also going to create an incentive for the VCs to invest in certain kinds of things that have certain kinds of expression into different markets. Like the capital markets are just going to behave differently here, I think, than traditional equities markets.
Kyle, you guys invest into a lot of applications that have real world or physical analogies in the stock market. How do you guys think about valuations and valuation methodologies when you're looking at kind of pure play networks that are more like Solana or Ethereum versus something that really has identifiable revenues and has a more kind of corporeal business strategy?
Yeah, I mean, I'd say we're kind of thinking about it like a traditional VC would. We construct at least what we think a hypothetical DCF could look like in the success case in 5 years' time, and then discount probability back to the status quo to see if that makes sense.
Sure. But do you agree with this idea from Avichal that the multiples are not going to converge between the crypto businesses and the real world businesses?
I think they are unlikely to converge in the next few years.
You think they eventually converge?
I mean, look, the 20 years, like, I don't know. That's kind of a silly prognostication. In the foreseeable future, no. And I think the reason is the players in the game are different.
Yeah.
Finance started out as like the elite of the elite, and it was like literally John Pierpont Morgan on Wall Street, like saving America. And like the history of finance over the last 100, 150 years is democratization of access, Robinhood, and now like crypto. And like, dude, there's still like 6, 7 billion people out there who like don't really know anything about investing. And so like, those people are not going to be sensitive to PE multiples when they're choosing what they're going to buy. I think the TikTokification of investing like perfectly captures why the multiples are unlikely to converge.
And so you don't think as this market has become more mature, as there are more hedge funds and more traditional investors coming into crypto, that is going to cause some convergence between those two worlds?
It will slowly compress, but I think it'll take a while to get there.
I mean, what was it? There was like, it wasn't, somebody just put out a report on DeepIn like yesterday. So, do you guys know what I'm talking about?
Yeah. Compound?
Yeah. I think it was.
Compound VC, yeah.
Yeah. So like, there is more. There are like banks and financial institutions writing research about crypto and claiming different valuation metrics. What's your take, Vance?
I mean, they're going to be twice the size as normal outcomes just because there's less float. Half of the cap table is held by retail, or it's in the treasury, or it's held for airdrop. So that makes sense to me. They're also, frankly, tokens are different capital assets than equities. You're using them to participate in the network. You're using them for different things. It makes sense that there would be some sort of like monetary / holding premium. I also think, people are willing to bid crypto, and I think institutions now as well, just because the prognosis for traditional venture and traditional, frankly, technology is so poor that anything that gives you a different look, maybe a little bit more liquidity, maybe just a different use case or capital asset, that will command a premium. Maybe over the long term that doesn't persist, but like again, you can't both believe that Bitcoin is worth $1 trillion and then also believe that like these will be valued like equities at the same time. If you view them as one asset class, if you view them as different, I think that's a different case. But tokens are more valuable than equity, and I think you're seeing that reflected in the TikTokification of investing and people just being more retail oriented in this asset class.
I mean, I would take it one step further. I think there will come a time at some point in the next 5 years, because I do think at maybe 20-year time horizon they converge, but I think there's going to be a window of time where it's just more rational for a company that has cash flow to launch a token that distributes cash flow from the company and effectively ICO that or give that token out to the market, because rather than IPOing on the NASDAQ, because just rationally speaking, the multiple that you get on your cash flow is going to be so much greater if you can reach everybody in Brazil and Nigeria and Indonesia and so on. And so it's just rational. So I actually think that I would take it one step further, which is it's gonna. I think the market will eventually realize that launching a token is better than IPOing.
Like what would the base token be worth if it was live today? You know, Coinbase is 40, 50 billion. Base is probably a 10, 20 billion dollar token.
Yeah. And in the limit, you could imagine the base token's network value is actually bigger than the Coinbase stock market cap. Mm-hmm. Like I think that's a very reasonable outcome over the next 5 to 7 years.
Same thing with Telegram. You know, if they charge towards an IPO and they get it done, maybe they go public at 10 or 20 billion. Ton is worth 30 or 40 billion today.
Right.
Like the incentives are very one-sided.
Kyle, do you agree with this take?
I generally think tokens trade at a premium to equities. I mean, that's empirically obviously true.
Sure.
And the question is why, and I think the answer is who are the players playing the game?
Right.
And I think the players in the crypto market are different than the players in traditional markets.
Right. But even, okay, let's say the base were to launch its own token, which, to be clear, we have no idea whether that's going to happen. If they were, presumably Coinbase would hold back 20% of the tokens, 25% of the tokens, right? So even if it were to trade in the neighborhood of 20, 30 billion or something like that, let's say, for the sake of argument, 20% of that is okay, they hold 7 billion.
That's huge, though. And
it is huge.
The second they do that, everyone else is like, they did what? We're going to launch it. We're going to get.
But it doesn't dwarf Coinbase's core business. Is the point that I'm making?
Well, no, I think there's a world where I mean, if Base looks a lot like ETH, what is ETH worth right now? Like, there's a crossover point, right? If you own 20% of the tokens, and if you sort of play, I'm not saying this is the case, not financial advice, obviously. Let's say ETH, is worth 10% of Bitcoin, or 5% of Bitcoin, 500 billion, $1 trillion. Is it so crazy that the thing that has all of the users, because Base far and away has more users than anything else, is worth 10 or 20% of that? Could it be worth, 100 billion or 200 billion, in the limit here, 10 years from now, whatever, and you own 20% of that? Like, you have $40 billion worth of Base tokens, and your market cap is $40 billion. That's actually not crazy, I think. That's an outcome.
Kyle, if you had to put a point estimate on what you think Base token would be worth.
I'm not speculating.
We got you here on stage to speculate. What the fuck?
I'm happy to talk about unlocks. All
right. We'll move away from that. So let me ask a question again. So we've gone into an era that is now much harder for VCs to enter into the space. In 2021, 2022, it was very easy for anybody with a half-baked idea about crypto to go raise a bunch of money and start calling themselves a VC. Now everybody knows it's much harder. But it's also true that every cycle, there's always the rise of a new generation of VCs. And they always look a little bit different. They always have different ideas. They kind of do something relatively new. So let me ask you this. If you guys were starting over today, you sort of had a memory wipe, reputation wipe, Twitter wipe, you're starting from zero. How would you rebuild your fund if you were starting from scratch, you had no name, no reputation?
I would either take I would concentrate, which is what we did with DeFi in 2019. I would either move to India, I would move to China, I would move to Hong Kong. I would try to get a vertical or a geographic bent. I would probably be DePIN oriented, or kind of a specific, I don't know, maybe like kind of public equity crossover. Like, you'd have to do something so different. I think the tough part about being a VC and starting out right now is, like, it's crowded, man. Yeah. And there's a lot of deals, but like, we still haven't seen kind of like a breakout small fund this cycle where someone like hits like a 1000x and is like, okay, you're now at the big boys table. And part of me thinks that may not be possible. I do think kind of like, the people that are doing a good job are like EB3, Alliance, like, Frictionless, like folks like that. But again, they're all so specific. I think that's kind of how you'd have to do it.
So your strategy would be DePIN in India.
Look, India's the new China. DePIN is, you can touch it. There's a physical, sometimes moat.
Yeah. But there's kind of like two dimensions to your question, I think. One is could you replicate what happened, let's say from 2018, we're all kind of like 17, 18-ish kind of starts. And I think that that 18 to 22 window was such a unique time in this industry's history that everybody here went from $10 million funds, roughly speaking, order of magnitude, to like, you know, billions of dollars under management. I don't think you're going to replicate that going forward. It's just like, that's how, you know, industries work. Like they go through a maturation curve, and we're in a different place today than we were 5 years ago. If there's a question of what would given what the macro situation is and what the market situation is, where LPs are and yada yada, what would you do today? I agree. Roughly, you got to focus. What I would probably personally do is move much more on chain and go anonymous. Like I think there's an opportunity to be sort of in Asia, doing stuff on chain, being outside of the sort of U.S. regulatory scope, being anon, and being really liquid on chain. And there's a lot of just low-hanging fruit right now. I think you could be generating very, very, very excellent returns if you're smart and technical right now on chain.
Or the other thing I would say is like, be more liquid.
Yeah.
Be more liquid.
I mean, there are 70, 80 Binance listings a year. The vast majority of them are uninteresting, but all of them do not have a structural buyer. And so I think that is the prognosis for a breakout success when you're starting a fund, is like, maybe you have a venture or hedge fund structure, it doesn't really matter, but can you buy some bargain basement stuff, maybe fundamentally oriented, maybe, you know, you're in the meme coin, Bacchanal, like it doesn't really matter, but like liquid, I would say, is how you could do it.
Strongly agree. Risk return in venture is poor compared to liquid today. So I would tell anyone starting today, focus on liquid. And you don't have to build a brand. You can. There's like some benefit that comes from it, but I don't think it's necessary.
I mean, you guys are the poster childs of liquid with a brand.
Yeah, I'm not saying, again, you said the point was wipe my memory, my
Yeah,
brain.
yeah, yeah. But like, would you not try to rebuild that brand as part of being a liquid manager?
I don't think it's strictly necessary. I think it is EV positive if done correctly.
Yeah.
But again, not strictly necessary.
Okay.
But I would focus on liquid growth opportunities. That's where I would play.
Okay. Fair enough. So the last question I have, because we're running up on time, is there's often a perception from people in crypto that VCs are in the room where it happens, that they are, you know, somewhere in the back room with the founders, kind of deciding what the next narratives are going to be.
There's a lot of smoke in the room and cigars.
Exactly,
Yeah.
exactly.
Yeah.
And you know, like I've seen them. You know, I've been in the rooms with you with the cigars.
Yeah.
So the question I have fundamentally is, when it comes to where crypto is going, what narratives take off, what becomes cool, what doesn't become cool, how much are VCs makers versus takers with respect to narratives? And how much do you think that you as a VC, as one of the leading VCs in the industry, how do you think about your responsibility to the industry in that regard?
Well, I think there's the thing that VCs would like to think is true, and then there's the thing that's actually true. And I think people would like to think that somehow we can influence this. It's sort of like, you know, VCs are not known as being low ego people, generally speaking. In reality, I don't think it matters. I don't think what the VCs say matters at all. Like, I think it has to be founder-led. I think it has to be, there's a notion of a community and some set of things that people believe that's almost like an emergent property of the project. Like Berachain's done a great job of this. Monad has done it. Keone was just up here. They've done an excellent job of this. Ethereum did an early job of this. Totally, you know, Solana did an excellent job of this. There's like some opinionated thing that they're able to project into the world. Because I think people in the market get very skeptical if the VC is carrying all the water. And it's almost like an anti-signal to your earlier question. So I actually don't think the VCs matter at all.
Okay. What do you say, Vance?
I think there's a difference between investing in something that you think will work and be enduring versus investing in something that you think the market will like. And like the latter is kind of the cynical take. And there's a concept of momentum trading. When something gets hot, you know, you just pile into it. You can do momentum venture in this industry. Like, ooh, you know, Celestia's at 20 billion. I'm going to do like the 18th DA protocol. Just like ship that thing out. And you can kind of see that sometimes where people are like, you know, oh yeah, I'm working on 6 DeFi protocols on 6 different chains. And like, we're just going to see where the chips fall. And I think the incentives will naturally go away for those people because retail should not buy those tokens. They should not be rewarded. But we take our, you know, job as a steward of the industry seriously, and, you know, if you shill enough bullshit narratives, like, people are just going to bail on you.
Yeah.
And so I think, you know, in the fullness of time, all of this will self-correct, but I do think the cynical people right now are probably making money doing it. And that stops at some point, maybe this year, maybe next year, but it's certainly not a long-term thing.
So the cynical people are the people who are takers, and the good VCs are makers? Is that what you're implying?
I think there's some element of truth to that. If you're shit hot on Twitter, you can make narratives happen. But I think like actually believing in the long-term enduring value of something that you're investing in, at some level you can't really fake that. And I find that most people can see through people who are trying to, just be a narrative massager versus kind of someone who's actually creating something.
Anybody you want to call out?
No, not particularly. Nobody on this stage. I don't.
Okay.
I think everyone here is good.
They won't hear. No,
they won't hear.
Yeah, no, nobody cares. What's your take?
Generally, VCs are takers of narratives. There are exceptions. Inadvertently, the largest maker of narratives by far in the crypto industry is Vitalik. Not intentionally, but just like he likes to write stuff and he's a curious guy. He's pretty smart and he says something and like it becomes a narrative. At this point, he knows that happens and just doesn't seem to give a shit. Which you can disagree with that decision or not, but like he can say
there's a curve there. He sort of was like, he didn't realize it. He realized it and was like, oh shit, and now he's like, I don't care.
Yeah, maybe he doesn't care anymore. I don't know how but like account abstraction or like roll-up centric roadmap or there's been pick your thing. I mean ZK, whatever. Like, so there's been a lot of that, and I don't want to put it all on Vitalik, but I'd say it like has come from Ethereum core, and there's been a lot of waves of it over the last few years. Again, I don't think it's like some intentional cabal coordinated thing, but just definitely it has sprung from Ethereum core repeatedly. And there's been tons of takers of those narratives. I think we have been involved in making one narrative, and that's DeepIn. And it took a lot longer to become a narrative than we thought it would, and it was a lot harder than we thought it would. I want to take some credit for that one. So VCs can be makers, at least partially, but it's harder than you think.
Yeah, I would say I think you guys are one of the most makery funds.
Yeah, I agree with
in
that.
Crypto.
Yeah, I appreciate that. Thank you. I think DeepIn specifically was like hard for people to grok the capital formation and like the risk and how the systems work, and like we really beat the drum on that for a while. But yeah, it's hard to make a narrative as someone who has tried and failed many times.
Fair enough.
I would argue though that I think it gets easier over time. Like the real lever to being a narrative maker is having a brand, and the brand comes from having a track record. So if you've done a bunch of stuff and you've been consistently right, when you do the thing, people are like, wait a second, maybe that's right. And then when you talk about it from a place of conviction, people are like, well, maybe that's a thing and I should pay attention. And so I think you might say like today, most VCs are takers, and I think in maybe 10 years, the leverage actually evolves, and a lot of the best VCs will become much more narrative makers by virtue of the track record.
Right. All right. So no smoky back rooms except in multicoin. Other than that, we're all honest actors in the market. All right. We got to wrap. Thank you, everybody.
Thank you all.